All right. Hi, everyone. Thank you so much for joining the session today. My name is Andra. I'm the Startup Program Manager at Aiven, and I'm really, really excited to host this conversation today with Sasha, who's a partner at Atomico. I'm going to let Sasha introduce himself in a moment, but before that, I just want to take a moment to tell you a little bit about Aiven and what we do. So Aiven, we are an open source data infrastructure platform. With Aiven, our customers can set up open source databases and deploy them on any cloud in only a few minutes. And we manage that infrastructure on behalf of our customers. We do that so they can focus on running their business and on building great products and not to spend time on building the data infrastructure. We were founded in Helsinki in 2016, and we currently have a presence on 3 continents. We're almost 500 people. And our latest funding round was a 210 million Series D in May of 2022. And we're lucky to have some of the world's top investors backing us, Atomico being one of them, of course. Now that you know a little bit about Aiven, I want to just tell you a few practical things about the session today. So I prepared a few questions for Sasha, and we're going to go into a really interesting discussion. We'll talk about the due diligence process at Atomico. We'll talk about trends in the startup ecosystem, how to prepare for investor conversations, and much more. And we'll also have some time to answer some of your questions at the end. So for that, we're going to use Slido, and I'm going to put a link in the chat in a second. And what I'm going to ask you to do is to go to Slido, add your questions if you have any questions, and then upvote on other people's questions so we make sure that we answer some of the most requested or the hottest topics. Then I would like to ask all of you as much as you can to keep your camera on if that's available to you, and to keep your microphone off to just make sure that we have a good environment here. And that's it from me, actually. Thanks again for joining. Now I've covered everything, and we're ready to get started. So Sasha, I'm going to turn it over to you, and I'm going to ask you to start off by introducing yourself, telling us a bit about your background, about Atomico, and getting us started.
Sounds great. Happy to do so. And it's a real pleasure to be here and to meet all of you. So I'm Sasha. I'm one of the partners at Atomico, and maybe I'll start off with a short introduction on Atomico and then quickly on my background, and then happy to dive deeper into any topics that might be relevant. But as a fund, we were initially started by Niklas Zennström, the former CEO and founder of Skype, in mid-2000s. And as cheesy as it sounds, he started Atomico as a fund that he wished he had raised from when he was building Skype. What it means in reality is that we strongly believe that beyond just investors that might be great thought partners on the journey, it's beneficial to have people that have had operating experience before, and they have scaled multiple companies themselves. And for that, we built a team of what it is now 15 people that are former, VP level, C-level people from Google's, Snowflake's, and others of the world that help our portfolio companies scale. We're now investing out of our 6th fund. Let's see where it went size-wise, but just to give you a perspective, the fund number 5 was $820 million. That's one of the largest, focus on the stage that we invest in. We have 2 strategies. One is we invest primarily around Series A, we call early stage. That's anything between $3 to $20 million. So that might be seed, that might be an A, that might be an early B. That's an early stage strategy that I'm a partner at. And then we also have a later stage strategy where we invest $20 to $50 million tickets. And that's where we partner with companies that have achieved some commercial scale already, and we help them achieve next levels. We are primarily focused on Europe. For our early stage, we also only do Europe. But for later stage, we can also selectively do US. But as Europe is our home turf, we kind of, primarily do investments here. And then maybe quickly on my background. So I've been with Atomico for almost 5 years. Started in something entirely different. I was a quantum physicist, spent a few years in a lab building what eventually became quantum computers. But 10, 15 years ago, quantum computing was in a different state. Most of my professional life I spent in the early stages, with the last 8 years investing. Started with another fund where I was focused on dev tools and open source, and that has remained one of my main focuses. And that's why I have been quite close to Aiven, as Andrew mentioned. We're thrilled to be a partner in their journey. We backed them quite a few years ago from our later stage strategy. But obviously, as one of the most prominent dev tool and infrastructure companies in Europe, it's been amazing to build this relationship forward.
Awesome. Thank you so much for the intro and for saying a few words about Atomico. I'd like to jump into the topic of today, and I'm actually curious to know a bit more about the due diligence process. So what happens after you meet a founder and an intriguing opportunity? What does the process look like? And you mentioned, the different stages there. If there are any differences between the different stages you invest in, maybe let's break it down that way.
Yeah, happy to kick it off with that. I'll try to keep it high level, and then we can dive deeper in Q&A session. But regardless of the stage, every time we meet a great team, we first try to understand what's their unique perspective on the problem that they're solving. And I think if we decide to continue the conversation and spend a bit more time with the team and digging into the opportunity, then we try to move very concisely focused on specific elements that we think are important for that specific opportunity. For some companies, it might be, is the tech defensible? How much of the product innovation is there? For some others, it might be around the market size. For others, it might be around go-to-market and a bunch of other things. So it's really dependent on the stage and on the opportunity, the type of the opportunity. I think if we're talking about the stages, going from the early stages all the way to growth stages, in the early stages around seed, you try to validate the problem and whether the team has good instincts, how to solve the problem. Around Series A, you try to validate product market fit. So you've already chosen a specific way to solve that problem, and we want to understand whether the customers perceive it as the best way to solve their problem. Series B, it's around scaling go-to-market. So you've already achieved product market fit. You want to play with a couple of go-to-market channels and scale them. And onwards from Series B, and probably starting from Series C, it's about scaling what's already working. So the focus of the due diligence and the depth of the due diligence will be very different, basically on the basis of what you can diligence, right? If it's a seed stage company, I think it's somewhat not wise to ask them for a detailed financial forecast, right? Because so many things will change. But if it's a Series D, E company, it's going to be all about the execution and financial performance. So I think across the stages, you'll be focused on different things. And I think for us specifically, we always try to narrow it down to 3, 4, 5 questions that really make it or break it, because you can spend with every company as much time as you want, but we're very mindful that the most important resource in every conversation with a company is the founder's time, right? You don't want to be distracting them too much, and at the end of the day, you don't want to you don't want this to become their job. They have businesses to run, and therefore we try to make it as least disruptive as possible.
Got it. And you mentioned the team there, right? You spend a lot of time with the team, and the team matters a lot. What are some good indicators of a strong founding team? And maybe even more specifically, because we have a more technical audience here, I believe, what are good indicators of a good tech team and a strong CTO?
Yeah. I think 2 things. So if we start from the very high level in terms of the team as the the force that executes on a specific vision, as collective, as a collection of team members, we really are looking for complementary skills, like people that have their own spikes, but that can cohesively work with each other. And that's, as a person that have been looking at dev tools and infrastructure for the last, 7, 8 years, I can confidently say that, especially in that space, people sometimes get very obsessed with technology, and you might see a situation where two, three founders are all technologists or are all product people, and there is very little commercial thinking or commercial muscle built out at that stage, which is somewhat fine, if the product innovation is enormous and you can potentially complement those people. But eventually you want to see a well-balanced team that has the required skill sets on the technology, on the commercial thinking, and on the go-to-market. And that's probably usually what you would say is a high-performance founding team. Then if you think about the individual team members, be that on the technology side or on the business side, what we really love to see is breadth and depth, basically the easiest to discuss, to describe, right? And what it means in reality is that you need to have good enough understanding of the context around the space you're building in, and understanding how different pieces interact with each other. But if you start probing questions on a specific area and go deeper, you would like to see very thoughtful approach to specific elements and a lot of insight that usually come from founders' experience. So let's say you're building in healthcare, right? And you start with the very top level, which is, healthcare is a $1 trillion industry, like eye-catchy phrases, right? Then would love to understand how much of the thinking that you have around the specific problem that you've chosen, how much that is already formed. And then if you go deeper into a couple of topics around the challenges around monetizing the product, the challenges around navigating different stakeholders, would love to either get insight why that is a good approach, or at least some hypothesis that still might be tested depending on the stage. Once again, for a seed stage company, it will be very different versus a late stage company. But you would like to see that the people that are building a specific product in a problem space, they have been living and breathing that problem, and therefore they are much more educated than you are on the space. And I think that's probably when you feel that you're even with all preparation in mind, if you feel that you're kind of learning a lot in that conversation, that probably is a good indicator of the amount of time that the team has spent thinking about the respective area that they decided to spend the next 10 years in.
Got it. Thank you. So you're looking at expertise, insights, even learning from a team. You're looking at complementary skills, people who can really build on top of each other and then form a really good team. That's in general when looking at a founding team. Then if we are to focus a bit on the CTO persona, is there anything that you're looking there, any, let's say, green flags when you evaluate a startup, and maybe also thinking about how the role might be changing from an early stage to a later stage? Is there anything you can share about how you look at technical founders there?
I think it's an interesting part because we always try to understand how the team can grow, right? Because you want to not only back the team as a collection of skills and characters in time, but also understand how those people might evolve and how they might grow. So I think at the end of the day, when we talk about tech and product, in the early phases, you want to see velocity of shipments, to put it very simply, because if you think about seed to Series A, it's a lot about finding product market fit, which requires a lot of feature development, that requires a lot of product iteration, a lot of smart ways how you can solve problems without blowing it into a big product, right? You can spend the next 5 years building this product, but how can you shortcut the path to hypothesis, either validation or invalidation? Then if you think about later stages, let's call it Series B and C, it's all about the scalability of it, right? Because if you had 5 to 10 customers at Series A, now you suddenly have 50 to 500 customers. How can you make it scalable? How can you make it reliable? And then if you think about going forward, that's where it's about stability and security, not don't get me wrong, like stability and security also are important at Series A and earlier and later, but the focus shifts constantly. And eventually, if you translate that into team, you want to see their ability to do so. So ideally, you look at what they have done before, not necessarily in their jobs, which is, good to have some pedigree, at least as a high level proxy to the training that those people have received. But eventually, it's all about how well you function as a product organization and as a tech organization. So talking about the green flags, it's about the technical progress and the product progress that is made between the updates. So for instance, if I'm on an investor distribution list, like where the company shares updates, and I see every month company ships like a new product, they ship new features, they make new integrations, that's usually a good indication of the velocity of change in their product and tech organization. The second thing is, if tech people also understand that their job is not only to build the product, but to deliver value. And they do not need to be commercially minded, but they need to be commercially aware, which, is a big difference. Like when you build product and technology for the sake of it, or when you try to solve problems with the help of product and technology. And you can quite quickly pick it up every time you discuss something with the CTO or CPO. You ask a question, why did you decide to ship this feature? Or how are you thinking about the product roadmap? Or what have been the challenges in the last 3 months, and how did you address them? Do you feel that you're resourced enough? And on the basis of their answers, you can start building understanding what are their priorities. And if their priority is only their wheelhouse, that's a bit concerning, because eventually you run into a situation where the business might need to go in this direction, but the tech goes orthogonally, because the tech people want to be obsessed with getting reliability to 99.999 instead of solving for what customers need. And I think in terms of the red flags, usually it's the biggest red flag is when you lose trust in the conversation. And it's funny because commercially minded people and commercial people in general, CEO, CFO, and other people that have something to do with fundraising, they usually are good at narratives and storytelling. And obviously, our job in due diligence is to verify some of the claims and understand better what stands behind those claims. And tech people are very straightforward in many cases. I don't want to generalize, but they tend to be more straightforward than not. And I think from that perspective, I actually find it very fulfilling and rewarding to have conversation with the CTO and CPO and so on, because that's where you can find opportunities, but also challenges. And the red flags are where the story doesn't stack up, where the tech people tell you one thing, the business people tell you something else, and that customers tell you something third. And especially if it's a big product or technology bet early on. So let's say it's a seed Series A company, you just can't really build trust in everything that you're told. And I think that's almost a dead end to that relationship, because how can you recover that trust? And usually you pick it up from small clues, but also from big clues as well. For instance, if there were some departures from the tech team, you really want to understand why that is the case, especially if the product sounds very ambitious. And we tend to speak to teams and look at products/solutions that are probably quite ambitious, and even on the tech side, not only on the problem and the product side.
Thank you. That's really insightful. And I kind of see how what you said about the red flags and the green flags ties back to what you're looking for in a founding team, which is complementarity and also a really strong relationship there, right? Which reflects in communication, which reflects in alignment, in understanding each other's priorities. Really insightful. Now, if we stay for another minute on the due diligence process, I'm curious if you assess companies any differently depending on the industry or the vertical. So for example, do you have a more rigorous process for more regulated verticals such as a medtech or a fintech compared to something else? Or maybe now with AI, has that changed anything in the way that you look at companies?
Yeah, I mean, it's a great question. I would separate that into the commercial and tech due diligence, and I probably leave aside the commercial. We can talk about that forever. But from the tech perspective, I think definitely, and also probably regulated industries and AI, I would separate. For regulated industries like healthcare and fintech, and sometimes ad tech, or anything that has to do with sensitivity of the information, I think the requirements for that are much more strict or are much stricter. And therefore, from that perspective, when we do due diligence, in many cases, we try to understand what are the potential challenges and risks that the choices that that specific team made pose to the company. And once again, when we think about the tax side, it's not diligence for the sake of it. It's diligence for the sake of very high level abstract view of the risks on the company. I can give you an example. Let's say you are doing something in healthcare. You're working with healthcare data, right? And you want to train, maybe to blend it together. You want to train an AI on healthcare data, right? Conceptually sounds brilliant, but unfortunately or fortunately, you cannot, blend data from different sources together, because the data for some use cases cannot leave the premises and so on. So I think from that perspective, when we do technical due diligence, we try to understand, okay, has the company taken any shortcuts, and are we okay with those shortcuts? Because maybe they decided to not care about ISO certification or any other regulation for the time being. That famous phrase, fake it until you make it, which I do not endorse for the record, but it's something that many people have chosen to do. So have they taken any shortcuts? And if yes, are we comfortable with those? And if not, are we comfortable with going into an investment while those still exist, or do we want to put some guardrails before our investment? In some other cases, it might be around setting what's called post-closing undertakings, which basically means that we will invest, but then we put a condition that in the next 6 months after our investment, you need to figure out how you treat your customers' data, which for an early stage company like GDPR and other things might not be forefront, and they need to almost fix them as they fly. And some of those are minor risk, but some of those might be major. Getting back to that healthcare example, let's say you've done something and we understand that if that gets uncovered and gets into a problem, let's say there is a data leakage or something like that, that might sink the company. And that's a very uncomfortable risk to take. And therefore, the things that might tank the company are usually the things that we would want to get resolved before we go into an investment. And if you speak about the regulated industries, there are like 10 times more things that can sink the company on the tech and product side than there are in non-regulated industries. So to answer your question, do we look differently? Yes, because the tolerance to being less strict about the way you build the product and the way you orchestrate the data is much lower in regulated industries, and we're not willing to take that risk, because at the end of the day, there are so many other risks that why would you take an additional risk which lies with technology? Maybe as an overarching comment, investors in general don't like to take risks of the product killing the company. It's okay to take the risk of, it might not work as we hoped, and therefore we might not deliver on the promise. But if it's something that really goes into a gray zone of treating customers, treating suppliers, being on the gray zone of regulatory compliance and so on, many investors will not be willing to take that risk. That being said, in the last 2-3 years, there have been quite a few big blow-ups where some investors were comfortable with that, which is, it's a reflection of the market, or was a reflection of the market.
Thank you. Thank you for talking about all those risks there as well. Now, if we are to flip that question in a way, what interesting or compelling things do you see or have you seen when evaluating companies? Maybe in other words, what does good look like for you in terms of how well prepared the team is to come to speak to investors?
Are you talking about the tech or the commercial or both?
I recognize that this is quite a broad question, right? We talked about tech before, we talked about different industries. Maybe let's focus on the tech for the purpose of this, or if you have a really good example on the commercial side, it would be great to hear that as well.
I think on the tech side, one of the bigger questions that we always ask ourselves is why the position that the company chosen is sustainable for the next 15 years. And you kind of need to appreciate that the horizons that we think about are probably 5 to 15 years. Because eventually, if you think about company being acquired or company going public, that's point in time for us where it's the end of journey for our relationship sometimes with the company, but it's a beginning of the journey for the new either acquirer or the public with that company. And therefore, whatever happens at that point, the incoming investors or acquirers need to believe in the next 5 to 10 years. So we think about the horizons of like 5 to 15 years, basically. And when it comes to tech, we as an investor, we also prefer to partner with companies and invest in teams that build something that is technically sophisticated and technically defensible. And I think it's a misperception that in software you can build something extremely defensible. There are very few examples where, for instance, there are network effects or there are specific unfair advantages that the company has. But as we all know, everything can be done, or many things can be done with the appropriate amount of time and resources. And therefore, if it took 10 people 3 years to build something, you can throw 30 people and probably build it a bit faster. So from that perspective, when we go into technical due diligence, even before technical due diligence, when we try to understand what's interesting about this opportunity, if there is something that is unique to this company, be that architectural decision that they made that makes them faster, better, cheaper, or some unique innovation on the product or technology side that is inherent to this team, or something on the product and tech sides that make this a more compelling value proposition, then we are obviously much more excited because we believe that better products fundamentally win better market share, which is not always true. Don't get me wrong. Like there are many cases where shittier products, because they were first got to a much larger market share. But then when we think about our technical due diligence, we try to understand what are those things that I just mentioned, right? So, for instance, if the company says, let's pick an example. Let's say I'm building an observability tool, and I'm saying that because I picked a specific database, I can provide my observability 10 times cheaper and 10 times faster than Datadog, right? It's a very succinct and compelling value proposition, at least conceptually, which might or might not resonate with customers. That's to be seen within the conversations with the customers. But on the technical side, we really want to understand it, right? And if we go into technical due diligence, we want to see, okay, how have you benchmarked yourself, whether you're better and faster, right? How have you benchmarked yourself that you can store it cheaper? What's your gross margin, and so on and so forth. So that's a very good example of a specific use case where you can see the impact of technology on the product approach that the specific team has chosen, and therefore it allows them then to undercut the existing market. So from that perspective, if the team comes with a very clear articulation why they are technologically better and how they want to go from where they are today, which is in many cases 5 to 10 people that have taped something together, all the way to this is now something that supports half of the Fortune 100. I think that's the thinking and the planning that we prefer to see. But once again, maybe to emphasize, if we are talking about an opportunity where the interesting element is coming from the product or tech perspectives, we would really try to validate that it's indeed the case, and whether the all of the T's are crossed and the I's are dotted. And the second is we would try to validate what the customers care. Because once again, as we all know, it's unfortunately not always what we are obsessed about as technologists is what customers care about. Eventually, they are building their own businesses, and then you might be faster, you might be cheaper, but they might not care. So that balance of does the tech and product make an impact and who cares is probably the two bigger buckets that we diligence in our processes.
Got it. And you offered really good examples and went into quite some detail there, but there's another lens that I'm curious to get your thoughts on. So I know you looked at a lot of companies in the open source space, among many others, but can you talk a bit about your views of open source technologies, maybe through the lens of any kind of bells that they ring in the diligence process?
Yeah, I mean, so I've started working with open source quite early in like 2015, and one of the first teams that my previous fund backed was a company called Nginx, the web server company, and that's an amazing story of the company being used or the product being used by almost half of the entire internet, but financially when they were acquired, they were not as successful. It was still a meaningful revenue generating company, but it wasn't in the hundreds of millions of dollars. So that's an interesting dichotomy. You can still have an amazing product that is harder to sell commercially. And one of the things with Nginx specifically was their open source product was so good that it was harder to convince people to buy the commercial part, because why would I pay 200, 300,000 if I can get 80% of the value in the open source domain? And then maybe extending that, there are two types of opportunities. One is when we look at pure play open source or commercial open source distribution model product, right? Let's say you built a database, you have an open source version of that database, and you try to monetize it. I think a big part of our due diligence there will be on just the commercial opportunity, because we know that it's very hard to commercialize open source, and therefore we need to come with eyes wide open into the diligence, trying to validate whether there is an opportunity to not only create value with open source, but also capture value with a commercial entity. But there is a second type of opportunities where the product is not the open source per se. The product is something that delivers value. Let's say it's a CRM, right? And CRM has many things. There is UI, there is front end, there is back end, there is database on the back end. There are like integrations with other pieces. And let's say we go into due diligence and we understand that 80% of what the product is just a few open source pieces that are stitched together, which is totally fine if you are building a business that can go in a path and generate some revenue. But fundamentally, it's much harder to get to the venture scale, and I'm talking about hundreds and billions of dollars in revenue with that kind of product. And then what we are focused on within due diligence is, do we care? Like, what's the tech stack? Do we care that the tech stack looks like this? And what do we think are the implications of this tech stack for the next 5 to 10 years? Sometimes you might hear that we've stitched this MVP with no code and open source, but we plan to rebuild it ourselves, which sometimes might be compelling, sometimes might be not. But eventually, you want to see why you have built something unique. And don't get me wrong, using open source is not bad and it's not good. It's just you need to use open source, in my view, where it's appropriate and where it's not the core of your uniqueness. If the core of your uniqueness is something that someone else built, why would then you as a team be the best position to capture the opportunity? So from that perspective, I think open source is definitely acceptable and encouraged for the things that you are not the best position to solve. For instance, using a Python library to check the quality of your data. If you're not a data quality company, it's totally fine, because that's not what your customers are buying. But if you are pitching that we will be we will be the fast, like, getting back to that observability case, right? If you're pitching that our unique advantage is because we use database X, and then eventually turns out that you are indeed using database X, but you have nothing to do with the database. 10 other teams can do the same as you did, right? Why you're uniquely positioned to solve this problem and get this company to a bigger scale.
Got it. Thank you. Yeah, it's very clear. In the end, it's about it's a technology choice, good or bad. Maybe there's no judgment, but in the end, the product has to deliver much more value for the customer outside of that,
Yeah.
and that's the non-negotiable.
And I think very important is to highlight that for quite long part of startup's journey, the biggest challenge that the company has is resource allocation. And what it means in reality is, like, are you better off spending 2 engineers per day on setting up your database, or are you better off those engineers spend time on something that is much more core to what you're trying to build? So from that perspective, if you think from the resource allocation perspective, then it makes sense to invest your resources where the ROI is highest. And it's very rarely that ROI is highest on building stuff that already exists. In many cases, it's going that extra mile that makes a big difference.
Got it. All right. I have 2 more questions for you, but I want to remind everybody here that we have Slido, and I'm going to post the link here again, and you can head over to the Slido link, add your own question if you have questions for Sasha, upvote some of the ones that are there. So I'll be checking that again in a minute. But now let's move a little bit away from the due diligence process and talk a bit more about trends and the general landscape. So I think it's important to talk about Gen AI. I'm sure you have views there. And I'm really curious to get your thoughts on how, in general, it's kind of impacting the business landscape. What trends are you observing, and what implications do you think it has on today's companies? I know that's a big question, so maybe feel free to share your hot takes here.
I'll try to squeeze it into 1 minute, and then if people are interested, happy to expand. But I think as a person that has been looking at DevTools for quite a while, I think one of the bigger questions is what is going to be developer of the future, if you will. What I mean by that is, once again, in that resource allocation paradigm, you as a human being, you want to spend your time on the things that are most fulfilling for you, but also you're the best position to do. And I think what Gen AI is doing is it's shifting a bit the balance between mundane tasks that developers are usually tasked with, and more creative things where it's all about the architecture and higher level thinking than lower level execution. And I think from Gen AI perspective, what we have seen across our portfolio companies, and I think it's a good proxy, is they all already are adopting AI, be that on the developer side, and probably that's the most advanced because it's a very well-defined task with very well-defined parameters and outputs. So developer productivity is going to definitely be enhanced, and therefore developers' time will be spent on things that are more important than just writing, yet another connector. And then on the business in general, I like to think about Gen AI as an enhancer of things that otherwise would be either very time consuming or would require quite a lot of resources. And therefore, what before would have taken you, 5 people and 100K will now take 1 person and 20K. And if you think about that paradigm, then you can start thinking, okay, what are the implications of it? And definitely where developers find their feet would probably be different. And I have been spending a lot of time just trying to think, like, what are the first and second degree use cases that might be automated with Gen AI. And I think on the developer side, definitely a lot of productivity is going to be gained from just having a copilot that help people write the code, not define the tasks. And I think defining the task will still sit with developers, and the more experienced developers are, the easier it will be for them to define those tasks. But Gen AI definitely might have a big impact when it comes to execution of it.
Thank you. I'm going to leave it up to people in the audience to ask more specific questions on Slido, and we can dive in. And I'm going to move on to my final question, which is, what advice do you have for founders looking for investment in 2024?
I mean, let's see where the market is, right? 2023 was a very tough year, I think, from the public and private perspectives, and I think it's from mid-February. It doesn't look that necessarily the market will reopen sooner than people anticipated, which is probably towards the end of this year, maybe early next year, maybe sometime next year or the next couple of years. Very hard to, I'm not going to pretend that anyone has a good idea of that. But I think from the advice perspective, my advice has always been, be that in good times or tough times, is if you fundamentally build good products and you solve for customer pain points, then it will correlate with the commercial progress that your company makes. And from that perspective, if you optimize for customers, commercial will pick up. And while commercial picks up, investors would definitely be more excited to speak. I think many people have definitely lost conviction in backing companies with just an idea, because now, as we chatted a few minutes ago, ideas might not be worth as much. It's going to be down to execution. So from that perspective, I think the advice here is, if you are in a privileged position not to think about the fundraise, really try to focus on delivering value to your customers, and therefore develop and progress on the commercial side. If you have to raise, and you might or might not be in a good position to do so, then try to portray a very clear picture. How do you get from where you are to the next stage? And I think, even though I mentioned to you in the beginning that we think about the next 5 to 15 year horizons, many companies die like in the next 1-2 years. So it's as important to think about the next 24 months as it is to think about the next 10 years. And if you don't have traction, or you might not have enough progress to validate all of the ambition and all of the vision that you have, having at least a very clear set of things that you want to validate and how you're going to validate them in the next 24 months is probably as good as it gets when it comes to increasing the chances to successfully fundraise.
Great, thank you. So now we're going to move over to the questions on Slido, and I see a couple of questions, and the first one that I'm going to read in a moment, I think that you've touched on it mostly with your answer now, but here's the question. What's more important in your tech due diligence, TRL or commercialization? Is it better to have the tech and want to sell, or to have the customers but no tech?
I mean, if you have the latter, it's amazing. I've rarely seen the case where you have the customers that bought nothing. So eventually you probably have something. The question is that something that you sold them really something that you intend to build, or not? And I think, maybe to generalize my answer to this, what investors want to see is some sort of predictability. And what it means in reality is that if you have tech, it's a predictor of you can build tech. If you have customers, it's a predictor that you can probably acquire customers. But if you have customers and you don't have tech, then it's a predictor of you can acquire customers but not have tech. And that's not a journey for getting to 10 million. So eventually, the more plain vanilla journey is you build tech, or at least the minimum version of tech that you can sell to customers, and then you portray, getting back to my previous comment, you portray what are the next steps between getting the tech from the state where it is today to getting a product that is fully formed. And once again, I don't think that anyone is delusional to expect enterprise grade product at Series Seed, right? It's very stage related. So at seed, you still will have a couple of design partners. The product might not be fully formed and so on, but having a combination of, we have validation that our tech is needed, and we have tech that is needed to scale the commercial, are probably two sides of the coin that you cannot say, one is more important than the other.
All right. Moving on to the next question. I think we might be able to cover all of them. How important is having a patent for novel IP at seed stage?
Well, it depends whether you're developing a new drug molecule or you're developing a new database architecture. My fundamental view is patents in software mean almost nothing, because there are very few cases where with a patent you can protect something that has only one way to solve that problem, right? With software. In the physical world, it's a bit more challenging, and you can also be smart about patents. So I think from that perspective, patent portfolio is usually helpful, but that would not prevent others from doing the same. Let's all be clear. If you have a patent for something, like for even hardware, let's say it's a display, you have a patent for a very unique display, and Apple, for whatever reason, or any other company, name it, decides to do the same. Well, I mean, you're a small startup. Are you going to be suing Apple or any other company for the next 5 years? Or you would be better off focusing on building the business. And I think from that point of view, if your unique advantage is in the technology that is also patentable, that's great. And if you have a patent, that's even greater, even better. But I think at the end of the day, patents might not source the defensibility that you expect. So from that point of view, it's not a critical element. It's a nice to have element, but it's really down to the specific examples where this might be relevant. I think, once again, in pharma, in chemicals, and in other things, it's more important than it is in other industries. So it's hard to answer without knowing the specifics.
Thank you. Next question is, what is your opinion on investing in companies where the market competition is heating up by bigger players?
Once again, I think it depends on the case. In some cases, it's all about distribution, and the bigger players, that's the main thing that they have, distribution, right? And therefore, if you can be okay with someone else having faster, larger, deeper, whatever adjective you want to use, distribution, then it's fine. There are quite many industries and product categories where we see startups attacking incumbents. Actually, there are very few, if there are at all any, industries where there is no incumbent, right? And I think there are good examples of like Nokias of the world and Blackberries of the world where they were an incumbent and they eventually got disrupted. And there are like a bunch of theories of disruption and whatnot. You can read about that. But eventually, every market has their own leader, whether that is the leader that is ready to be or that is ripe for displacement. I think that's a big question. And I think in many cases, if you go head to head against Google, Apple, Microsoft, and others, you need to think really carefully and hardly, are you really that much better than what they provide? Because in many cases, unfortunately, as I mentioned, even though I believe that the best products longer term capture the biggest market share, shorter term and mid-term, it's incredibly hard to get to a decent state where you can have a privilege of being the owner of the big market share, right? And therefore, we see that happening now with pretty much anything cloud infrastructure related, pretty much with anything AI related, right? Where bigger players, and I'm not talking about the gorillas, necessarily about the gorillas, but even companies of a couple hundred million in revenue, they already have an inherent advantage. And then if you launch yet another product X, then you need to really answer to yourself honestly, why do I need to exist? Because if you read the pitches, all of them have the same chart, competitive analysis. Everyone has red crosses, and we have all green check marks. And unfortunately, if that was the case, we would have been making and printing money, that day and night. So I think answering yourself honestly, like, do we really need to exist? I think it's a paramount to start in a company, but also at every major milestone of that company, really question yourself. And if the answer is yes, then you should definitely go for it. There are good examples like Perplexity, right? Right now is going after Google, and they deliberately say, the way we know search today is not going to be how people look for information in the next 5 years. That's a bold statement, but they have a specific reason why they think they need to exist.
Got it. Thank you. Just a quick reminder to everyone, there's a Slido link in the chat. We have a few questions. If you want to go to the link and upvote any questions that might be interesting to you, please do. I'm not sure now anymore that we'll get to all of them, so feel free to do that. In the meantime, the next question is, which verticals apart from AI are receiving the most funding in 2024?
Well, we are, a month and a half into 2024, so hard for me to say. I can tell you from 2023, DevTools, like just looking at our pipeline, right? The companies that we have seen, DevTools and infrastructure was a big part, 10 to 15% of the entire universe of companies that we have seen looked at. Then climate is a big one, also probably 10 to 15%. AI was off the charts, probably around 30%. HR and productivity and future of work was another one. And then procurement and supply chain has become extremely hot this year already, probably towards the end of last year. Probably those are the bigger categories, but maybe, I don't know what's the background for that question, but as a caveat, I would say, I think the best way to either start a company or to build for the next 10 to 15 years is to have a conviction on the problem and really have deep desire to solve that problem, irrespective of what is happening around. Because the sheer fact that we're seeing, so much Gen AI is not only reflective of the power and the paradigm shift that Gen AI might be bringing, but it's also reflective of people thinking that, oh, it's a good opportunity to make a quick buck, right? Because my friend and his, my neighbor and his dog raised a round, so I can do it as well. So why don't I just, put AI to whatever tagline I had before and raise yet another round? I think that's a very, very, very doomed way to build a company, because eventually it's not, the hype is here today and it's not here in the next day, but you are stuck with this company for the next quite some time. And you might see a bunch of those examples from cloud in early teens, all the way, and mobile even before, to crypto in mid-teens and early 20s, and now Gen AI and so on. So I think I would just be very mindful that whatever VCs are funding or whatever your friends and neighbors are talking about, probably not the best, not necessarily the only reason why you kind of might be excited about a specific area.
Thank you. Yeah, and if I think back on what you were saying earlier, in the end, I guess the takeaway is build what your team is uniquely positioned to build based on the insights that you have and the skills on your team, rather than whatever hype might be going on.
Yeah, Gen AI is a great example. Like, you ask, why are you building this Gen AI observability tool? And people are like, oh, we thought it's a idea worth exploring and solving. But then before we did, I don't know, like general DevOps. I mean, are you really the unique team that needs to solve this problem? I think kind of not unanimous views here.
Yeah. So there's a bit of a battle in the chat for the question that's going to come up on top, but we have one that seems to be most popular now, and we only have a few minutes, so this is probably going to be the last question before we wrap. Do you have any recommendations for space tech?
Space tech. Yeah, actually, space. I actually spent quite significant time in space tech. If I were to summarize it, is balancing longer term vision with short and mid-term value creation. Because we all might want to mine minerals on other planets, which is great, but that's probably quite a few years away. So the vision and the market, the potential market and the ambition is there, but what are you going to be doing in the next 5 years? And I think there are quite a few problems that are worth solving that are related to space that make our life 10x. And I think one of the things there is how can you enable better data connectivity, how we all can maybe message to each other through a satellite from our mobile phones, or how can you have better Earth observability and whatnot. So those are the things that still are ambitious and large enough at the end, but they are solving pain points that exist today. And in the next couple of years, you might see the progress, because those moonshot ideas, and the pun is intended here, the moonshot ideas are great, but in the startup world, it's not only about who goes after the biggest problem. It's also about who can survive for quite a few years before that big vision and ambition gets realized.
Wonderful, thank you. Well, we still have 2 minutes, so I'm gonna throw the last question at you. Feel free to be very, very quick. Question is, what is your suggestion on finding the right investor that will have the same go-to-market strategy as the founder?
Well, investors should not have the same go-to-market strategy. They should be buying into what you think is the right go-to-market strategy, and you should be very confident that they are going to challenge you, but eventually you're building the company, they're supporting you. If investors know how to build the company better than you, then they probably should build that company themselves.
Wonderful. I knew that was going to be a quick one. Thank you so much. Thank you, Sasha, for sharing so many insights. I feel like we could have spent another hour talking, but that's our time. Really appreciate you joining. I really appreciate all of you for staying engaged, for sharing questions. If you want to get in touch, you can find us on our website, on LinkedIn. You can reach out to me. Sasha, if you're happy for people to reach out to you, feel free to wave. If not, that's okay. But you can find our websites very easily through a Google search. So appreciate you all. Thanks again, Sasha, and have a good evening, everyone.
Pleasure speaking to everyone. Thank you so much, Andrea, for inviting. Cheers.
Thank you. Bye.
Thank you. Bye-bye.